Back to the economy, we talked a little bit earlier about how the market seems encouraged by the fact that a cooler GDP report in the United States might mean fewer rate hikes ahead. And yet that report coming on a day where there's still signs of lingering inflation, that's going to raise some concerns about a so-called stagflationary environment. Let's get some perspective from Yelena Shulyatyeva. She is U.S. economist at BNP Paribas and joins us to talk a little bit more. Always nice to see you, Yelena. Let's talk a little bit about the sort of the key takeaway on where the economy is based on the data we got today.
So I think the latest GDP report is showing that economic momentum is slowing. But I think the headline reading actually overestimates the intensity of such a slowdown. Beneath the surface, it's still a lot of strength in the consumer sector. So we saw consumer spending contributing 2.5 percentage points to overall number, and the biggest negative surprise is coming from inventories, which is a very volatile component. So I think to just sum it up, growth is still there. It's just a slower rate, and we may see something slower going into the current quarter as well. We still expect a recession in the second half of the year, but until then, I think we will continue to see this mild growth kind of indicators, on the economy.
And given some of the cooling effects on the Canadian economy, we have already seen the Bank of Canada for a couple meetings now hit the pause button because there's obviously concerns about the aggressive pace of rate hikes we've seen over the last year. And I alluded to the fact that we are gearing up for another Fed decision next week. What are your expectations?
So what it all means for the Fed? Well, the Fed will hit the pause button after the May meeting. This is our expectation, but they will probably leave some optionality in the statement and in the press conference for further tightening, because the degree of a slowdown in the U.S. economy is just still not indicating an imminent downturn. So we still are adding jobs, we are still growing, and inflation is still at the levels that would probably, just if you take that alone, would require further tightening. So it will really depend on the senior loan officer opinion survey that the Fed will receive at the meeting and how they interpret what is going in the economy and the degree of tightening that they will need to eventually deliver. So our expectation is for another rate hike at the May meeting, and then the Fed will leave the options open with a little bit of a hawkish tilt to the communication at the meeting. But the forecast is for a pause following the May meeting.
And just more specifically on inflation itself, do you think we're going to see more signs of inflation easing, or are we just going to be sort of stuck in this cycle where we're reminded that getting those prices back down to more normal levels is challenging?
Well, inflation kind of showing signs of peaking, and in the main categories such as services inflation, I think we still need to see a little bit more to be convinced that is happening. It's clearly slowing much slower than we would want to see, but if we continue to see a slowdown in economic growth and eventually a fall into a recession, that by itself should fix the inflation issue.